Hey, welcome back to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can subscribe to all of our podcasts at americastalking.com. To support Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We're recording today's episode on Wednesday, August 28th. Joining me as always, my friend and colleague, Dr. O, Orphe Divounguy, PhD economist. Dr. O, I have been glued to your column at the Center Square every Monday. I think you're bringing something new, interesting, insightful about what to watch in the week ahead. Every week's a little bit different. I mean, yes, there are standard reports that come out, monthly. We're heading into September here, so we're going to get a whole new batch of data that's measured on a monthly basis. Kind of the word for the week is labor. We're going to get, among other things, we're going to get a report Wednesday on job openings. And then Friday, there are three independent pieces of data that are going to come out: the employment report, the unemployment rate, and then we're also going to learn about U.S. hourly wages. And so why don't we focus today on labor and talk about what's coming and what you think the numbers are going to look like.
Yeah, I mean, last month we had a big scare, right? The big scare was a big increase in the unemployment rate.
Yep.
The markets reacted you saw the stock sell off, yields falling, right? The flight to safety, everybody got panicked, thought that maybe we were on the brink of a recession and that the Fed had made a huge mistake by not cutting rates at their last meeting. So let me just add one more thing before I go into the report. It takes time for the Fed actions to show up in the real economy, and so if the Fed made a mistake, then it's chances are that it's going to be very difficult to correct with just a 25 basis point rate cut or even a 50 basis point rate cut at the next meeting. I happen to be one of those people that doesn't think the Fed made a mistake. I think the U.S. economy is on solid ground. It's slowing, but basically consumers are outspending. Lower inflation has helped to support households. The fact that most families, and when I say most, I mean really most, families own their homes in the United States and have locked in very low mortgage rates and low mortgage payments, low housing payments, means that they were kind of shielded from the increase in rates.
Yeah.
The fact that many of these households are sitting on, oh, by the way, you look at consumer credit, and even though delinquency rates are now higher in terms of credit card delinquency rates and auto loan delinquency, it really falls on younger people, most likely renters, and those people actually, most of them have jobs because the labor market's been pretty strong.
Yeah, let's. I think a lot of your prophets of dooms and purveyors of gloom. What's your lines?
I think
I'm pretty close.
Prophets of doom and charlatans of doom and prophets of gloom are out there.
Okay.
With their predicting a recession for the past 2 years now, right?
Specifically with housing, okay. The market's going to crash. We're going to have something that looks like the 2008, upheaval. And to kind of stretch out the point that you made earlier, I mean, the vast majority of people who own homes now are not on those crazy 3, 5, 7, 1 arm, loans that they took, those mortgages that they took, where when the rates went crazy, they were basically pushed out of their own home based on the changing rate that they were having to pay. Because more people are on conventional loans now and have rates that are lower. It's a different kind of pain in the housing market. It's mostly the renters that are
That's right.
at issue and at risk
That's
right
right.
now.
That's right. It is exactly. It is renters that have seen their rents increase faster than their wages during the pandemic, that are rent burdened, that can't go out and buy a home either because, hey, I am rent burdened. I may have a lot of credit card debt. I've an expensive car payment, and
Mm-hmm.
I potentially also, and I'm also facing much higher mortgage rates, which would
Mm-hmm.
make it my monthly payment much higher. So like it is those people that have the result has been lower housing sales in the past couple of years, right? Uh, and even those people, some of them living in markets where the rent is more expensive, uh, are actually able to trade their high monthly rent for the high monthly mortgage payment, right? As long as they
Mm-hmm.
can come up with a down payment, etc. But the
Right.
point of this is that really, and by the way, you still have people that are able to roll over costly debt and basically trade it for credit cards with zero, with introductory 0% rates, and so that's still out there, right? Bank lending is improving.
Mm-hmm.
Financial conditions have eased. The stock
Mm-hmm.
market is near record high, and so if you're invested, you did well. Uh, and yields have declined, and so all of those things are actually helping the consumer. We saw last month retail sales surprising, the upside surprise in retail sales. We got an upside surprise in new and existing home sales. And so,
Mm-hmm.
in my opinion, you have an economy that's still pretty strong. You have a consumer that is slowing down, mostly out of caution,
Mm-hmm.
uh, as opposed to out of desperation because
Right.
they can't do it, right? They can't afford anything anymore. And then at the same time, you have a Fed that's indicated that it's literally going to cut interest rates at its own next meeting.
Yeah.
And so all of that is essentially stimulus for the U.S. economy. And so the jobs numbers next week are expected to show a small rebound in
Mm-hmm.
employment growth. Um, and so hopefully we see. By the way, up until now, it's been a lot of it has been labor supply driven. More
Mm-hmm.
people in the market, more people coming into the labor force. Even if hiring rates don't change, that simply means more jobs being created.
Mm-hmm.
I'm expecting we're going to continue to see that. Although I think maybe we might hit somewhat of a ceiling in terms of how many jobs we're going to continue to create,
Yeah.
but that would be completely normal. I don't expect layoffs to increase at this point. I think we're probably going to be growing at a more sustainable pace.
Mm-hmm.
And all is well in the world. All is, and so that's kind of what I see coming forward in the next jobs report. I
How
hope
about
that we're going to
wages?
continue to see.
How
I think
about
wage growth
wages?
will ease. Wage growth will ease, right?
Okay.
There's the unemployment rate is higher at 4.3% now.
Mm-hmm.
There's more participation, so wage growth could continue to ease. But I really don't see the labor market cracking as of yet. And I think the
Yeah.
easing in wage growth is actually good because the Fed will be justified in cutting rates. It will say, hey, inflation's very low. If wage growth is easing and productivity is rising, then that means inflation's really, really low. And so there's a reason for the Fed to cut before things deteriorate. And so the Fed will cut, and that actually will keep the U.S. economy humming
Mm-hmm.
for most of 2025. Of course, I don't
Okay.
know. Let's not go further out because the forecast gets terrible as you go
Oh, I'm
further
worried about
out.
next week, let alone next year. So yeah,
Exactly.
I
Exactly.
think that's fair. Well, yeah, I look forward to seeing your thoughts on these subjects and others Monday in your column at the Center Square. That's the Everyday Economics by Dr. Orphe Divounguy. call it good there. For Dr. O, this has been Chris Krug. Subscribe to Everyday Economics and dozens of other high-quality podcasts at americastalking.com.